Okay. Okay, it's time. Before I start, any questions on the class where we are? No, I'm keeping my eye on that Google shared spreadsheet, the master sheet, see what companies are showing up, and I'm glad to see the company column starting to fill up. So again, at the risk of nagging you one more time, if you haven't picked a company, please do. And if you're pondering which company to pick one and move on. And you can always come back and change your mind. This is not somehow, something you can't reverse. So make sure you pick a company because it'll make your life easier and it'll make the learning much more tangible if you're actually trying it out in a company. Okay? So let's pick up where we left off on Monday. We were talking about markets and how much we trust them and mistrust them. I'm not going to thrust my views on you. I mean, you're going to get a sense of where I come from with markets very quickly as we go through this class. But I want you to think about what it is about markets that bothers you. Because let's face it, we're all, especially in the aftermath of what's happened in the last few years, and after watching what happened at GameStop, a lot of people saying, well, I have no faith in markets. Markets don't work. And in fact, if you look at the basis for the argument that markets don't work, we've actually in economics and finance actually dug a lot into this phenomenon. It's called behavioral finance. Behavioral finance is about how psychology plays out in markets. Now, Kahneman, who is one of the fathers of behavioral finance, won the Nobel Prize for it. And he has an incredible book on it. If you get a chance, read it because it shows you how psychology plays out. That people are not quite rational. In fact, I have what I call the Elvis Presley test for rationality. You know what the Elvis Presley test is? You've heard of Elvis Presley, right? Let me put the first part of the test to you. Let's see how many of you passed it. How many of you think Elvis is still alive? Okay, good. You've all passed the test. But have you ever read USA Today? You've read USA Today, right? It's the McDonald's version of a newspaper, which is you can get through the whole paper in about 12 minutes. They have a poll every day. And you have 250 days a year. You run out of questions to ask. So I remember it was about on the 15th anniversary of Elvis's death. Elvis incidentally died in the 1970s, and 15 years later, USA Today runs a poll. It says, do you believe that Elvis is still alive? 15 years after his death. 72% of Americans said no. Thank God for small blessings. 21% said yes. 21%. And 7% said, I don't know. Have you noticed this about polls? No matter what the question is, there is a floating 7% that refuses to answer the question. The poll could ask the question, do you know your name? 93% of Americans said yes, 7% said, I don't know. An incredibly paranoid fringe walking around and said, don't ask me any questions. I don't want the answer to be held against me. 21%. Population in the US is what, 300 million? Let's extrapolate. 21% of that is 66 million people walking around thinking Elvis is still alive. Remember that. Because when we create these constructs of rationality, and you look at every economics model, every finance model, it's built on the notion that investors are rational. I keep reminding myself, there are 66 million people wandering on thinking Elvis is still alive. Of course, markets are going to do crazy things on any given day. So I'll preempt the critiques of markets. There are three broad critiques you'll hear about markets. One is that markets don't react properly to news. They either overreact to news or they underreact. They're slow learners or they learn too much. The second is, and this unfortunately has become almost a prevailing wisdom, is this is some kind of an insider conspiracy. Who are the insiders? Those guys. We don't even know where they are. They get together in, I don't know, some Masons club, and maybe there's an equivalent of a Freemasons club, a free hedge fund club. They get together and the whole thing is fixed. And the third is, and this is often a very common critique, that markets are short term. You've heard that, right? Markets are short term. They're focused on what happens in the near term. They don't care about the long term. I told you I wasn't going to preempt what you think about markets, but presumably you have your own views on markets, and let's kind of extract them out, right? Especially on the short-termism. So I'm going to see if I can pull up the poll. It's not even letting me. So let me actually, since I can't pull up the poll, for whatever reason, let me make it a physical question. Sorry. So you ready? You don't even have to kind of put up your hands, think through the answer to the question. So here's the statement. I want you to tell me whether you agree or disagree with the statement. Focusing on market prices will lead companies towards short-term decisions at the expense of the long term. Agree or disagree? Okay. So as I said, I'm not, it's show of hands in a Zoom class is kind of crazy. So, you kind of made your decision. So whatever choice you made in the first one, let me ask you a follow-up question. Allowing managers to make decisions at companies without having to worry about the effect on stock prices will lead to better long-term decisions. Agree or disagree? So first question was about markets being short-term or long-term. The second question is, do you trust managers without having the thrust of prices on them to make long-term decisions? Agree or disagree? Okay, made that choice. Here's the third one. Maybe neither managers nor markets can be trusted. Maybe we need regulations and laws forcing companies to make long-term decisions. You know why I'm making you go through these three steps? If I give you any particular group, markets, it's easy to say, I don't like markets. Markets are short-term, okay? Remember, ultimately, you got to trust someone. If you don't trust markets, I'm going to ask you, do you trust managers? Are they really long-term? And if you trust neither managers nor markets, somebody else has to be making this choice for you. Do you trust regulators and governments to do it? Again, I'm not going to prejudge your response, but when you get into conversations about, hey, I don't trust markets, we shouldn't let markets make decisions for us. My question is, okay, who are you going to trust instead? I want to, as I said, I won't prejudge you, but I'll tell you what I think. Do markets make mistakes? Of course. They're crowds, right? We've heard of the wisdom of crowds, but we've also read about the madness of crowds. In fact, there's a book that came out about 16 years ago about the wisdom of crowds, where they take discipline after discipline and they find that what the crowd comes up with is often much better than what experts come up with. I mean, that's why when we pick restaurants, we don't look at restaurant reviews, we look at Yelp reviews. Yesterday, when I had to decide what to watch on Netflix, I didn't go through what are the 10 best shows. Netflix is actually tough because they don't show the reviews, but no, I went to Rotten Tomatoes. That's crowd wisdom. But at the same time, you also have crowd madness. It's a book called The Madness of Crowds. It was written in the 1800s, and it was written with the tulip bulb craze, basically talking about how crowds, when they got caught up with emotion, ended up doing crazy things. So Are crowds wise? Yes, but they're also mad. So of course, markets make mistakes. But I'll tell you something. When managers tell me markets are irrational and short term, and they said, trust us, we're going to make long-term decisions, I wouldn't take that trust 10 feet away because I don't trust managers to make long. If you think somehow managers are long-term and markets are short-term, you're really having to talk to too many managers. Managers are concerned about what's my bonus going to look like this year? What can I do? If you think managers are more long-term than markets, you've been talking to very different managers than I do. So maybe the answer is to have regulation, right? Who writes regulation? Regulators and politicians. Do you think regulators and politicians are really long-term in their thinking? This notion that somehow there's this magical group out there that's long-term, that's going to make the right decisions for you is an illusion. You've got to decide who to trust. And given my experience with these three groups, managers, regulators / politicians, and markets, I'll take my bets with markets every single time. So let me back up and argue that markets are not as short-term, even though this has become conventional wisdom that markets are short-term. I'm going to argue that there is evidence out there that might not prove that markets are long-term, but it's clearly inconsistent with markets being short-term. Airbnb went public November of last year, right? Young hospitality company. The market cap of Airbnb yesterday was $120 billion. Airbnb now is worth more than the top 5 hotel companies put together. How much money did Airbnb make last year? It lost a lot of money. If markets are that short term and all they care about is earnings right now, then how do you explain the Airbnbs, the Ubers, the Palanters of the world? If you ask me, I think markets are far too long term. They give companies credit for things that are going to happen in 15 years. So if there's any evidence on the ground, it's not that markets are too short term, it's that they're too long term. And when you look at companies which have a lot of current earnings, mature companies versus growth companies, in this market, guess who's priced higher? It's not the companies that deliver earnings now, it's the companies that are getting their value from future growth. I'm not saying any of these prove that markets are long-term or investors are thinking long-term, but I'm saying if you look at prices and you look at what kinds of companies are priced high and priced low, I can't back up this notion that markets are focused on current earnings. And here's one final piece or evidence that is at least consistent with the notion that markets are more long-term than we think they are. When a company makes an R&D expense, trace me through what happens to its earnings. You're a company, you increase your R&D budget from $1 billion to $3 billion. What's going to happen to current earnings? The way accounting is done right now. R&D is treated as a operating expense. So when I spend $3 billion instead of $1 billion, I report lower earnings, right? Now, if you believe this notion that markets are somehow focused on current earnings, what should happen to companies when they make R&D announcements? The stock prices should go down. Markets are short term. Let me show you what actually happens. If you look at a bunch of announcements like R&D, which are designed to create long-term growth at the expense of current earnings, what you get actually, if you look either at the day that the announcement is made or the longer period, is positive effects. For the most part, when companies say we're giving up current earnings for future growth, markets cut them a lot of slack. The one exception seems to be product strategies. Let's face it, product strategies, the emptiest of all announcements. There's nothing behind it, right? We're going to have a new strategy. Nice. What does that even mean? But if you look at any tangible announcement that companies make for future growth, markets, for the most part, bend over backwards to give them credit. So when managers complain, look, we can't invest now because markets will punish us, my response is, maybe you're the kind of company markets should punish for investing now. And here's what I mean by that. Is R&D a good thing or a bad thing? John McIntosh?
It depends, I guess.
It depends, exactly. It depends on what?
Sort of how targeted or sort of the strategies behind.
Whether the R&D is designed to pay off, right? So when, let's take a company in the news right now. Moderna announces that it's going to increase its R&D expenditure because it wants to come up with more of the drugs that, or the treatments that have worked so far. My guess is they announced we're going to triple R&D. The market's going to reward them, saying, you know what? You have some track record here. It looks like you're succeeding. We're going to reward you. If Merck announces that they're going to spend $3 billion R&D, you know what my first reaction is? That's another $3 billion down the drain. I'm going to take $3 billion off your value. For the last decade, Merck has spent more than $100 billion in R&D. It's the equivalent of the GDP of a small country without creating any earnings. Why? Because it's an older pharmaceutical company. I don't know what the R&D people at Merck do. I'm sure they're good people, but it's not paying off. Of course, markets are going to discriminate. Not all R&D is good. Not all acquisitions are good. That's the market's job. So none of this will convince you that markets are long-term. But what I'm saying is when people just throw that out, markets are short-term. I see that on CNBC from celebrity gurus saying markets are short-term. Based on what? Based on your gut feeling? You're saying, what about crises? That shows you markets have gone crazy. During crisis, markets are all over the place. We could go back to 2008. People after the 2008 crisis said, see, we told you so, you can't trust markets. I know most of you are too young to live through the 2008 crisis, but you know who the primary culprits in the 2008 crisis were? They were banks. The most regulated portion of the economy was the one most responsible for taking the economy down. And you know what? Markets actually survived the 2008 crisis, provided liquidity and allowed us to come out. But let's take last year. Did markets behave well or badly last year? They behaved a lot better than experts did in every dimension. If any of you watching CNBC all the way through the year, terrible practice, let it go. But if you've done that, all those market gurus who came out in the middle of March, remember what they were saying? The world is ending. Sell everything, head for the hills. It's over. And markets said, hang on. This too shall pass. In the middle of the year, people said, vaccines take 3 years to develop. There's no way the economy is opening up. And markets said, you know what, this could be different. We think vaccines will come sooner. Take a look at what experts were predicting on almost every single milestone on the economy and what markets were predicting. And you be the judge as to who turned out to be right. So right now, markets are forecasting that the economy will come back strongly. And there are, of course, a lot of experts in economics say, no, I don't think so. And if I were to bet on which one of these outcomes is more likely, given the track record of experts in markets, I'm going to pick markets every time. So I'm not saying markets are right, but I'm saying the collective judgment of markets often beats experts on. I mean, there's actually a book on this, The Fox and the Hedgehog. Have you read this book about, experts versus people who are, kind of dabble in multiple things? It's actually incredible because the book actually takes you through discipline after discipline, looks at what experts are predicting and looks at what these collective, unwashed masses are predicting. And the collected unwashed masses often come up with a better prediction than the experts do. I'm not going to talk you to trusting markets. That's something that's got to come from within. I'm just saying when you decide to abandon markets, remember you're replacing markets with something else. Whether it's managers, regulators, politicians, you decide whether that's more trustworthy than markets are. Because that's the choice you face. There is no perfection out here, no universal being that's going to tell you this is long-term, this is short-term. We all have to make our judgments. Any questions about markets before, before we move on?
Just one question.
Go ahead.
You would choose long-term version of the market over short-term, though.
I don't get to pick the market I want, right? I've got to live with the market I have. I would like markets to weigh the long term appropriately, right? So let me give you an example of where I want the short-term picks over long-term. Let's suppose you have a project that could deliver $1 billion today and another project that will deliver exactly $1 billion 10 years from now. Which one would you want the market to pick? Julie?
The first one.
The first one. If I asked you between $1 billion today and $10 billion 10 years from now, you want the market to say the second is the better choice. We can't prove that markets do it, but if you look at R&D, that's basically what the market is facing, right? Do you want the earnings now, or do you want this higher earnings in the future? And at least on average, what are markets doing? They're giving you credit for future growth. So I want markets to be long-term, but I can't force them to be long-term. Are there times when markets are going to be short-term? Absolutely. You know why? Because they're composed of human beings. But so are managers and so are regulators. The only difference is, do you trust 6 experts sitting in Brasilia or Moscow or Tokyo to make your decisions? Or do you trust this larger market that has people coming in and out for lots of different motives, and that it's really the question of, do you trust the crowd judgment more than a group of experts, which is essentially where this question about markets comes down. Any other questions about markets?
Isn't there a problem with there's a tragedy of commons aspect to it, though, right? A lot of these negative externalities that we're talking about, right?
Which is,
because it's a large group, the market, the cost of that is borne across the market. One person, one investor.
It's not even that the cost is borne across the market. There could be costs borne by society that are not factored. I'll give you a very simple example. If you're a company and you minimize taxes paid, as a shareholder in the company, is this a good thing or a bad thing? Don't think too long. It's a good thing, right? You increase your earnings, increase your cash flows, you might attach a higher value. But when you pay less taxes, that's also less revenue to the government. And that basically is a cost we all bear as society. So it's not even that the externalities are restricted to the market, they're to society. And that's going to be my next question, is even if you trust markets, what do you do about those externalities? Because markets are not being irrational in ignoring taxes, but taxes matter to the rest of us. You're a member, or you're a shareholder in a company, but you're also a part of society. So maybe after we talked about it, Henry, you can come back and kind of extend, but I think that's a very good point. Markets do what they're supposed to, but even if they do it right, you could still end up with these side costs. Ashwin, you had a question?
Yes, Professor. With regards to the banks and the 2008 question, I've read that one of the big problems there was precisely deregulation by the government, the Clinton administration in the late 90s, which created incentives for the banks to act in ways that they did, which led to the crisis. So isn't that maybe an argument that some regulation is still warranted?
Oh, I think that, but let's face it, regulation always has this problem of unintended consequences. I'll give you an example. One of the problems in the 90s and going into the next decade was managers' employee contracts. If you look at stock-based compensation, was primarily in the form of options. And options are not a great way to make managers think like shareholders for a simple reason. If you remember from foundations, or even if you have a passing sense of what options do, you know what risk does to options, right? Higher variance makes options more valuable or less valuable. They make options more valuable.
More.
Which means if I reward you as a manager with options, guess what you do? You tend to take bigger risks than you should because you get more upside from the risk, even if it's not good for the overall company. You think, what's this got to do with governance? You know why companies shifted to options? In the early 90s, Congress passed legislation designed to cap executive compensation. This is an argument like Groundhog Day. Every 10 years, you will see the show. Executives get paid too much. We have to stop this. So they wrote a law restricting how much CEOs could get paid. But when they wrote the law, companies didn't use options. So options were not included in how they computed the cap. So the intentions were good. They wanted to restrict how much CEOs got paid, but what they created as a side cost was this whole option game that got played out for the next 20 years. In the 1990s, when you had deregulation, the original idea was that banks, because they had this deposit base and customers, could offer more financial services to individuals. I'll give you a simple example. When I first came to the US and I put my money in a bank, I earned no interest, even if I kept it, because the argument was, where are you going to go? Merrill Lynch broke the game open by creating money market funds. Money market funds basically allowed you and I, as small investors, to put our money in the equivalent of T-bills. Now we take it for granted. The deregulation was written, perhaps the best of intentions, to allow banks to offer these products that would be better for their customers, but in the process, it created a monster, which is, it then allowed banks to go to riskier businesses, which by itself is not bad, but use the capital that they got as a bank to play in risky games, which means if you lost the game, your depositors face consequences, and governments can't let depositors lose money. And so you created this societal cost. So in hindsight, you're saying those bad regulators, they'd written, I'll ask you a question. If all you needed was regulation to keep banks in line, how do you explain Indian banks? There's lots of regulations on what they should or shouldn't do, but they're disasters because there are ways that they've gotten around the regulation that has created bad loans to family companies. So I'm not saying we shouldn't write regulation. I'm just saying that there are some things where regulation is going to work, but some things where the laws of unintended consequences are not going to create the benefits you want to, like corporate governance. If you think we can regulate our way to better corporate governance, you have a lot more faith in regulation than I do. You've heard the saying, you get the government you deserve. If you're a democracy and you vote for, you get the governments you deserve. We get the corporate governance we deserve. As shareholders, we don't even look at who's on the board. We don't care what the corporate government. You know what? You can write all the laws you want, they're not going to work. So let's talk about the last component here, firms and society. In the utopian world, if you remember, there are no social costs and no social benefits. Why? Because we assumed them away. We did the classic economist thing. But in practice, every business creates both social costs, externalities to society, and social benefits. There's no point even arguing that that's absolutely small or large. So let's talk about what it is that makes this component so difficult to deal with. The first is social costs and benefits are difficult to quantify because, remember, Donald Rumsfeld, he used to be Secretary of Defense under George Bush, and he'd come and give a press conference and he'd say something and he'd say, what did he say? That was either something incredibly smart or completely stupid, I have no idea. And in one press conference, and this was during, during the Iraq War, he said, you cannot know the unknown. Part of you is saying, that's really deep. The other part is saying, what the hell are you talking about? But I'm going to borrow from Donald Rumsfeld. You cannot know the unknown. And here's what I mean by that. We think of social costs, and we think bad companies create social costs and good companies don't, right? Remember asbestos? It was a wonder product when it was created because it was light, was easy for people to carry. So instead of carrying heavy metal and which would hurt your back, it actually helped people when they built, this is a wonder product. Well, it turned out that 20 years after asbestos became part of almost every building, that the people who worked with asbestos, were around asbestos, started developing cancer. John Manville went down to business. They went bankrupt because of that. You think that's terrible. They should never have created it. They did not know at the time that they created that. I'm not talking about the companies that know the costs are there and don't let you know. I'm There are lots of companies that create social costs and don't even know they're creating social costs until it happens. And what did we find out? That smartphones destroy brain cells by the thousands every time you talk. By the time we find out, we'll all be too stupid to even figure out what they're saying. But to blame Apple for something that you couldn't figure out until 15 or 20 years after the product. So the notion that if you're a good company, you can avoid social costs, let that go. You have no idea what costs you're creating, sometimes until 10 or 15 years later. The second is social costs and social benefits, by definition, are in the eye of the beholder. You know what I mean by that? What we think of as bad for society will vary across the room because it depends on what we put high on the list. So if you're an environmentalist, your definition of social cost might revolve around climate change, fossil fuels. For you, ExxonMobil is the worst possible company on the face of the earth. It's the devil incarnate right there. ExxonMobil, any traditional oil company, because that's what you care about. If on the other hand, you care about employee rights, whether they get paid a reasonable wage, any company without a union, for instance, Amazon last week had this union vote, I think somewhere in the South, and they fought it to the end. I might say that's a bad company. They don't really care about what I care about. And if you care about privacy, you know who you hate right now, right? Every social media company is on your top 10 list of terrible companies. Imagine being in a group and you're looking at a project. You work at a company, you're looking at a project. There are 7 people in the room and you're asked to bring social costs into the discussion and social benefits. I'll wager that if you let every person bring their top item onto the list, you will never make a decision. It leads to decision paralysis. But every company now claims to be a good company, right? ESG, we're going to talk a little bit more about that. CSR, Corporate Social. I mean, I've seen acronyms come and go, and I'm not even sure what the right acronym is, but we know what the acronyms stand for, which is we want companies to be good. And if you look at the annual reports of companies, they spend a lot of time telling you how good they are. It's almost like they're putting themselves out for sainthood. Look how good we are. Look how much good we do. So I'm going to take companies at their word. They say they're good companies. Disney is very big about what a good company. Let's say you work at Disney. You've decided you want to be a good company. I come to you with an investment opportunity. A store you're going to open in an inner city neighborhood, and the inner city is basically completely devastated. There are no stores there, no jobs. You're going to open the store, and by doing it, you're going to help to revitalize, maybe give employment. But I'm going to make this very clear in terms of the choice, because I don't want to give you any escape hatches of saying I'll open the store and use it as advertising to get more revenues in my other stores. No, this is a store that is going to lose you $1 million a year for as long as the store is open. There's no end game. It's a money losing investment, but it's going to create social benefits. Ready? There's no right answer to this question. You're a Disney employee. You've read the annual report about how good you are as a company. And you can replace store with any other investment you want. It could be a movie you're making where you open movie making to parts of society that were shut out, but you're going to lose money. Would you take this investment? I was going to do a poll, but obviously my polling is not working. Now think about it. Would you take this investment? Okay, you made your choice. If yes, anybody say yes? What? So this is how deep your goodness is when you have to spend real money, you're not willing to spend it. Already you can see that many companies talk the talk, but they can't walk the walk. They talk about how good they are, but they say, would you be good enough to give up 200 million? No, not that good. Somebody be my guinea pig. Come on. This must be a good person in the room who says, let's put society's interest. Dan, how about you? You be the good guy.
Yeah, I said no, but I'll be the good guy for the conversation.
You be the good guy, okay? If you say yes, then you're clearly taking a money-losing investment, right? Would you be open about this with your shareholders? In other words, you don't have to reveal every bad thing, but the shareholders meeting that year, when you get up, you're going to say, look, this year, we're going to spend $100 million in investments that will not make us money. They'll actually lose us money, but we're doing this because of this social objective that we think we can get. Would you be willing to be open with your shareholders about that?
I guess I would have to, but I'd probably try to pad it within or make it seem like it was advertising or something else.
And I think therein lies the second problem, is if you actually put money being good, it's not your money. It's shareholders' money. You're being charitable on their behalf. How generous of you. You're the CEO of a company. You take my money and you give it to the Met as corporate. How dare you? Who are you to make that judgment for me? But that's basically what you're doing. But I'm saying if this is something that shareholders agree is good, then they will say yes. But they might sometimes say no. And I'll tell you what's going to make the difference. If you're Tesla, and you say, look, we're going to take 100 million and buy, Bitcoin is a bad example. Let's make it a charity, something society will gain from. We're going to invest it in research into electric cars, and we're just going to write it off. You think Tesla shareholders will go along like that? Why? Because Elon Musk is asking, and they trust him with everything. I mean, they trust him to invest in Bitcoin. What's this? And second, they're going to be okay because what's happened to the stock price at Tesla over the last year? It's gone up 400%. I remember when my oldest son was about, it was confirmation. I'm not Catholic. I didn't realize how lucrative confirmation can actually be, because people come and they were passing him money for his confirmation gifts. And to just give you some background, he is perhaps the stingiest person on the face of the earth. He's the kind of person who would lick his sandwich and throw it in the trash so that his siblings wouldn't eat it. So at the end of confirmation, he collects his spoils. He has like $300. And he turns to me and says, Dad, I'd like to give $100 to the poor. As if I have some direct conduit to the poor somewhere, But basically he said, look, and I said, that's very generous of you, Ryan. I mean, why do you feel? And he said, I feel rich right now, Dad. And that, in a sense, gives you a sense of why some companies can afford to spend a lot of money being good and others cannot. Tesla announces we're going to spend $100 million being good. Stockholders say, fine, I've done well. GM says the same thing. I don't think they're going to get a great response from their shareholders. They say, look, my stock price is down 40%. You want to beat me up one more time? And if you say no, then I think I'm going to confront you on your hypocrisy. There's a lot of hypocrisy in this entire discussion. Companies, it's easy to write the words, I'm a good company. But if you're truly good, you have to accept the fact that it'll cost you some money somewhere along the way. That is part of the game. And if you're doing well enough for your shareholders, they will trust you to be charitable with their money. But the key word is, do they trust you? So let's summarize all the things that can go wrong, because in a sense, we've ripped apart every utopian assumption, right? Shareholders have little power over managers. Managers put their interests first. Lenders lend money to the firm. They don't protect themselves. They're going to get Nabiscoed. Let's introduce that word into the language. Nabiscoed means you don't protect yourself. You're going to get ripped off. Managers sometimes lie to markets, but almost always try to control the flow of information. Remember the Friday evening news dump. And companies create social costs and social benefits. So in this world, you can see already that if I ask CEOs to just maximize the stock price, they could do it in very dysfunctional ways. You could increase your stock price by ripping off your lenders. You could increase your stock price by lying to markets. You could increase your stock price by creating huge costs for society. And none of us wants that to happen. So you're saying, what do we do then? Well, Traditional corporate finance breaks down, right? Because maximizing stock prices is no longer the only objective. You got to bring in something else because every part of the assumptions are broken down. So I'm going to take you through 3 pathways you have now. The first is you can pick a different governance mechanism. You know what I mean by different mechanism? The mechanism that I've described, who's responsible for making sure companies are governed right? It's shareholders. So we've got to read annual reports, we've got to see who's on the board, we've got to push for change. And even if all of us don't do it, we need lead shareholders, activist investors to do it. So maybe instead of looking at traditional, maybe there's a different government, maybe somebody else can keep an eye on managers. The second is maybe we can pick a different objective. Instead of maximizing stock prices, how about maximizing growth, maximizing earnings, maximizing market share? And God help you if you hire a consultant to come in because they'll give you an acronym, maximize EVA, maximize CFROI. It's better than maximizing stock prices. Or third, you might maximize stock prices with constraints. You know what I mean by constraints? Something to keep you from wandering off the reservation, doing some really bad stuff. Let's start with the first choice, maybe a different corporate governance system. Let's do a little history. The end of the Second World War. Japan and Germany, as economies, were in complete shambles. There was nothing there. 1945, neither country had much on the ground. War, the ravages of war had destroyed the economies. And in true miracles, economic miracles, over the next 40 years, they built themselves back up. By the mid-80s, Germany was the second largest economy in the world, and Japan was the third largest economy, or vice versa. They kept switching them. And they did it with a very different corporate governance system than the US. The US and the UK are stockholder-based systems. Japan didn't use shareholders. They created what were called kairitsus. You know what kairitsus are? They're companies bound to each other by shareholdings. So you'd have 50 companies bound together in a group. See, how's governance going to work there? Here's what the kairitsu system did. They said, if one of these companies is badly managed and badly run, the remaining 49 managers will get together and replace the 50th person. You see the difference between this system and the US system? So rather than shareholders doing it, the group managers would act as an internal disciplinary mechanism. And it worked really well for 40 years. Germany had a similar system with a bank in the middle. Let me explain. Deutsche Bank would be the largest single stockholder in Allianz. Allianz would be the largest single stockholder in Daimler, and Daimler would be the largest single stockholder in Deutsche Bank. And they were all supposed to keep an eye on each other. You see what these systems share in common? A mistrust of the people who buy shares. A mistrust that they didn't go to the right schools, they don't have the right background. It's an elitist system, whether you like it or not. It's a system of, hey, the managers know what to do because they have the right training, the right background. But who can fight success? It worked really well. In fact, the Ministry of Finance in Japan in the mid-80s was one of the most highly regarded expert groups in the world because they brought Japan from nowhere to this very large economy. In fact, they were doing so well that many strategists decided that this was the way to go. You've heard of Michael Porter, right? Strategy guru. In the late 80s, he wrote a book where he argued that what US companies should be doing is being more like the Japanese, that they should create their own kairitsus. Forget about the stockholder stuff, keeping managers in line. Managers would keep each other in line. And it sounded really good in 1987 when it came out. Look, we want to be like the Japanese. And then you got to the 1990s and you saw the downside of these systems. And here's what the downside was. In the early 90s, banks around the world had serious problems having lent to real estate, and real estate prices had come down. This was true across the world. So you go back and look at what happened in 1992. Citigroup almost faced real trouble because they had so many bad loans. But you know what? US banks took the charge. They all lost money that year, and they moved on. There's pain in that year. But you know what Japanese banks did? Remember that 50 companies bound together by a group? Let's play this out. Let's assume that 49 of these companies have made bad real estate loans. And the 50th company is run by the one person in this group with the foresight to say we shouldn't be doing it. In the Japanese system, who's replacing who? You think the one guy who did the right thing is going to replace the other 49, or the other 49 guys are going to get together and say, hey, you know what? What's wrong with you? You're not a team player. You're fired. In 92, Japanese banks, rather than face up to their problems, pushed them under the surface, surrounded the problem, and said, what problem? And you know how the rest of the story played out, right? Because Japanese banks refused to admit their problems, it started Japan on a long-term path of economic stagnation because nobody wanted to admit a problem. The problem with expert-based systems is experts hate to admit mistakes. Think about any dimension of life where experts run things. When they screw up, you know what the first reaction is? Not to say we screwed up. They can't. They went to the right schools. They're not supposed to screw up. They cover up their mistakes, whether it's the military, whether it's science. Expert-based systems have egos. And because of egos, they don't like to admit mistakes. You can dislike what markets do, but markets have zero egos. You know what I mean by that? You have a stock that's highly priced, Airbnb, 120 billion. Tomorrow we discover that the Airbnb business model is a mirage. You know what could happen to the price? It could go to zero. Markets say, hey, mistake, sorry, let's move on. So if you're tempted by one of these elitist models where somebody who's better equipped, more informed is going to make the decisions, factor that in as a cost. I'm not trying to say it's a bad model. Most of the time, it is actually a more efficient model than the US model. But when you have systematic problems, it doesn't do a good job. In fact, what happened in Japan happened in Korea too with chaebols, because Korea was structured very much like Japan with the cross-holding structure in the late 90s. Korea paid a price for this. Now, if you go down this path, the German and Japanese path, you're buying into a different kind of corporatism. I call it managerial corporatism, where companies are run essentially with managers at the center. Every interaction they have, whether it's with labor, with banks, with society, with governments, is all about making sure that managers are protected. It might not be a bad thing if managers collectively are good people, they're the best interest, but it is what it is. Managers are the center of the universe, and every decision is going to be driven by, hey, is this going to make the manager feel better or worse? Last session, we talked about acquisitions, right? And I gave you my very cynical perspective on acquisitions. Acquisitions are more likely to destroy value than increase value at public companies. And the larger an acquisition, the more value is destroyed. You'd think, and we've known this for a long time. But let me ask you a question. Have the number of acquisitions dropped off over time? Of course not. Which means that when companies make acquisitions, shareholder wealth must be way down in the list of things they're looking at. So you're saying, why do they do acquisitions? No, there's a company called Gulf and Western, which was a conglomerate built up in the 1960s and 70s. And Charles Bluhdorn, who was the CEO of Gulf and Western, was open about why he did acquisitions. He said, I want to build the biggest company in the world. He was an empire builder. He said, I don't care what I pay. I'm going to make the biggest company. What managers value the most is then going to drive, because in a sense, there's no challenge to them. Their shareholders have little power. All they have to do is keep their peace with the other managers. That's managerial corporatism. But that's a little better than another version that comes out of these elitist systems. I call this crony corporatism. You know what you do in crony corporatism? A founder or a family still runs a firm, even though it's a public company, they might own only 15%. But they maintain their power because they have the right connections. Connection with whom? With governments, with regulators. Asia is full of crony corporatism. You could have, in fact, many people are cynical about the US argue there's crony corporatism here too, which is connections between. So what you have here is companies going out and essentially getting into agreements with the people who should be regulating them, should be taxing them in a way that increases their value. The problem with crony corporatism is it depends on connections, right? And what's a good connection today could become a bad connection tomorrow. So that if your biggest competitive advantage is we know the right people, make sure those right people stay in power, because they lose power, then you lose power as well. What I'm trying to say is, it's easy to abandon a system. So you don't like stockholders having power, you throw it out, say, I'm going to replace with something. Think about that something before you throw what is out, because everything comes with consequences. So you could try a different governance model, but be very, very careful about what you see as the end result. If you look at countries where stockholders have almost no power, it's not like companies are better companies and they're much more long-term. They're just different companies. They're companies focused on managers, or companies that are essentially run for the best interest of an inside group of shareholders, who are either founders or families, but they really are no better. In fact, often they're worse than companies that are driven by shareholder interests. Any questions about different corporate governance mechanisms?
Yeah, Professor, I have one question.
Go ahead.
When you talked about the Japanese system of something like collective responsibility thing, wouldn't that kind of diminish competition, kind of like all they bind together and push down new entrants or any kind of new company?
It could be. In fact, it could. That's a good point, because if you have power go away from the shareholders, why would you ever invest in a young startup, right? Because that startup has to fight its way through the system. So when you look at if you look at the growth of technology companies, why the US has still remained the place where technology, remember, Spotify is a Northern European company, but it chose to go public in the US. There's a reason for that. There's a reason Alibaba and Baidu have chosen the US as their base, because the US stockholders are much more receptive to investing in young companies, because they feel, rightly or not, that they have a little more power in how this game plays out. So there are other costs too, which are broader economic costs. You're absolutely right. Yeah. Let's choose a second path. So let's say you don't want to go with a different governance mechanism. You want to keep the existing system. You just want to choose a different metric. Increase earnings, increase revenues, increase firm size, increase market share. So instead of stock price, you say go maximize market share. You know the problem with every one of these objectives is? They're intermediate objectives. And let me explain what I mean by intermediate objectives. Kushal, why does a company want a higher market share? What do you gain by having a higher market share?
Greater revenue.
Greater revenue. But what if I told you the only way you get a higher market share is by selling below cost? You get the higher market share, but at what cost? So there's got to be a second piece, which is once you get the market share, you use that power to raise prices. And now we're approaching a very dangerous line, because if you have enough market share to be able to influence prices, this is the whole basis for antitrust laws. We're going to stop you. But increasing market share makes sense only if you can show that higher market share leads to higher profits, higher cash flows in the future. I still remember when I think it was 1981, American Airlines got a new CEO, a guy called Robert Crandall. And I remember watching his first press conference. And he stated his objective. He said, I want to make American the #1 domestic US airline. Let me repeat that again. He said, I want to make American the #1 domestic US airline. By the late 80s, it succeeded. The #1 domestic US airline in terms of number of passengers flown. But in 1988, there were only 2 airlines that were making money in the US, and neither was named American. One was Alaska Air. Why? Because nobody else, I guess, wants to fly to Fairbanks at that point in time. Remember, Alaska Air then was really an Alaska to mainland air. And the other was the Young Southwest. You know what the Young Southwest flew? Dallas to Houston and back again, back and back. And so they said, we don't care about LA to New York. It might be a glamorous route. We're going to fly those routes where we make money. Novel idea, right? That an airline is supposed to be making money. My point is, American accomplished its objective of becoming the largest airline, but at what cost? So if you decide to go with a different objective, maximize earnings, maximize revenues, maximize market share, think through the consequences. Because remember, when we maximize stock price, we looked at the weakest links. What can go wrong? I want you to think about what can go wrong if you pick a different objective. And I've tried multiple objectives. Every one I can create for you horror stories of what that objective will lead to if left unchecked. And of course, there's this new game in town. Why don't we make everybody happy? There's a fairness argument here, right? Which is, hey, this is so unfair to focus on shareholders. We've got lenders, we've got employees, we've got society. We've got to give them a reasonable say. And this seems like an easy fix to this problem of side costs. It's just maximize stakeholder wealth. And as companies are under siege for lots of different things on a PR base, it's a PR move too, which is you say, I care about stakeholders. Who's going to say that's a bad argument? So let's talk about stakeholder wealth maximization, because right now, ESG and stakeholder wealth is not a side story. It's now something that people have bought into. And these are people with lots at play. You go to the Business Roundtable? Business Roundtable is composed of CEOs of some of the largest companies in the world. They're about as disconnected from reality as the people who show up at Davos every year. I've always wondered, why the heck do we even listen to these people who show up at Davos? The selection bias here alone should lead you to say nothing that comes out of there could ever make sense for the rest of us. Well, the Business Roundtable is, so clearly they have power, right? They run big companies. And about 2 years ago, they put out a message. In the message, they said, our job as companies is not just to care about shareholders, but to take care of our customers, take care of employees, take care of society. It was a really, I mean, you read that, nobody could contest the goodness of the statement. Clearly, this is so good. They're going to care about all of us. And that's become the selling point for stakeholder wealth maximization, right? Let's make everybody happy. Now, we have 4 children. There's a group of 6. When we were all together as family, we used to go for summer vacation. If I defined the objective as we want to keep everybody in the family happy today, you know what ended up happening? Nobody would be happy. And in a strange way, by trying to keep everybody happy, you end up with this confused mess where nobody is happy. Because what you've created is a recipe for passing the buck. And here's what I mean. So I'm going to pick each of you. So Lindsay Schiff, you're going to be my shareholder group. So you're watching. William, you're going to be my lender, the bank that lent me money. Shruti, you're going to be employees, basically. And who wants to be the government society? Vamsi, you can be government and society. So Lindsay, I come to you and say, look, this year our stock price was down 15%. What's your first reaction? That's not good, right? But they say, but don't worry, I took good care of the lenders, the employees, and society. That's why I couldn't do things for you. It'd be churlish of you to say, look, I want higher stock prices because I'm doing this for the good of everybody else. William, I come to you and say, look, I forgot to make an interest payment a couple of months ago, but don't take it too personally, because that money got paid out as higher wages for employees, and you want higher wages, right? You don't want them to live on poverty wages. Now, Shruti, I come to you, I actually didn't pay you higher wages. I've been cutting your wages. And he said, you know what, I can't pay your wages because the shareholders are putting a lot of pressure on me, and the lenders seem to want me to make their interest payments. And then I get in front of, whoever stands for society, a politician, a regulatory group, and said, look, I'm under a lot of pressure here. I have to pay employees a living wage. I've got to pay the lenders their interest and principal payments. Shareholders keep asking me whether the stock price is going to go up. By making me accountable to everyone, you've essentially made me accountable to no one. I know when I wrote this, people said, but there could still be entities that could do this, right? My response is be very careful what you wish for, because we've seen entities that serve multiple masters before. I grew up a long time ago in India when every company was pretty much a government-owned company. Because most companies are not, they were either family-owned or government-owned. You know what the mission statement, if you were the CEO of a government-owned company, was? Here's what I want you to do as a CEO. I want you to make sure the company delivers a profit. And by the way, while you're doing this, I want you to build factories in these 3 parts of the country because they need employment. And while we're doing that, I want the employees, because they're my voters, to get about 20% more in wages. Oh, by the way, you do all of that. I want you to keep the prices on your product low because customers need it. Who wants this job? And you know what government companies did, right? They delivered crap. Not because the people who ran them were not bright people, but because they were being pulled in a dozen different directions. But if you really want to see what happens when you muddle your mission, you know what you should try doing? Work where I work, which is a research university. What's the end game for? In fact, every entity needs a mission, right? If I asked you, what's the mission of a university? Jane, how would you describe the mission of a university? Jane Stein, what's the mission of a university?
I'm not really sure. Just kind of make as much money as possible and educate
I hope
students.
That's not. If that were the mission, they're doing a terrible job. You know why? Every university that I know of runs 10% below its revenue. So no matter how much they collect, they always lose money. Don't ask me how this happens. So their end game is making money. They're doing a horrifically bad job while charging you obscene prices. At least in theory, a university is supposed to be about education, right? If you defined a university as where you go, so the mission should be about delivering a quality education at the lowest part. Do you think that would be a pretty good mission? If that were the mission, what's the group in a university should be at the very top of the list? Who pays the most tuition at any university? It's undergraduates, basically. They are the heart of a university. You know where undergraduates fall in the list of interest groups in a university? Definitely not first. You've all been undergraduates at colleges. You are the lowest person in this totem pole. You know where the power lies at a research university, right? Who's the apex group in this? Who gets first dibs? Come on, you can be cynical, and I won't take it personally, because I'm part of that group.
Tenured professors.
Tenured professors. And we write our own rules. Like what? Well, you know what? This teaching is so onerous. I will teach only 3 classes a year, which works out about 8 hours, 6 hours a week. That's a lot of work. I don't think I can pull off more. And because I'm working so hard, every 7th year I'm going to take off with pay. It's called a sabbatical. Oh, by the way, once I get tenure, you can never fire me. What entity that has any sense of preservation would agree to these terms, right? This makes no sense to allow people to have a job for life once they get tenure. And of course, whenever tenured faculty are pushed on this, you know who they call on, right? Galileo. Remember what happened to Galileo when he told the world that, basically he told the world, it's not flat. What happened to him? Did he get the equivalent of a Nobel Prize? No, he got executed. So we all claim to be doing this original research that if you didn't give me tenure, we wouldn't do. What a bunch of crap. The reality is the research we do is read by so few people that they wouldn't even bother coming and scratching our heads, forget about hanging us. If it sounds like I'm down on research universities, it's because I'm down. Let's face it, this is what happens when you have no idea what your mission is. On any given day at a university, you'd say, oh, we have to do well for research faculty. We have to do well for people. It's almost like you have a shifting coalition. And when one group is not well served, we always use the other groups as the excuse for why we didn't serve this group. Do you want every company to become a research university? God help us if that happened. So now, let's talk about ESG. Sounds so good, right? In fact, the ESG promise is we all get cake with no calories. It's good for everybody. Who can resist that? Let's take every group. If you're a company and you're good, what do I tell you? You're going to become a more valuable, a more profitable company. If you're an investor in companies, what do I tell you? If you invest in good companies, you're going to make higher returns. And of course, with society, we said this is good. Society will gain if companies all buy into ESG. But let's start with the prompt that I've already mentioned. Who measures goodness? How do you measure goodness? This is not like profitability. We can say margins measure profitability. Return, we can have some debate, but we know how to measure profitability. How do you measure goodness? And to see how this plays out, right now there are lots of services that measure how good you are as a company. They measure you with an ESG score. It's a big, booming business. Morningstar just bought into it. But here's a problem that you face. If you look across these services, there are about 5 or 6, there's very little correlation, the rankings of these services. What I mean by that is you see a company that's ranked at the top by one service, it's ranked at the bottom at the other. And these are some very high-profile companies. On one service, Facebook is ranked as one of the best companies in the world. You know why? Because that service measures fossil fuels and carbon emissions as a big deal in measuring goodness. And of course, Facebook has lots of problems, but emitting carbon emissions is not one of them. But there's another service that ranks Facebook towards the bottom because they have a data privacy as a big component. This is not a small problem, and it's not a problem that's going to go away. Because let's face it, we don't have a consensus on most of these issues, right? If I threw out many societal issues, half of this class will say, I don't care about them, and half of this is the most important thing in the world. So the starting point for ESG is already flawed. How do we measure goodness? Because we cannot. How do we decide what companies are good and what are bad? But let's look at the actual facts. Is ESG good for companies? Is it good for investors? Is it good for society? Because this is an empirical question. On the first question of do companies benefit from being good, I'll give you both the good news and the bad news. The bad news is there's almost no link between being good and profitable. There are some bad companies that are very profitable, good companies that lose money. There's almost no correlation with profitability. Could I give you anecdotal evidence? Of course I could. I could say, look, Patagonia makes money because it's good. But that doesn't mean Nike can do what Patagonia does and pull off the same trick. If you look at the overall evidence, there's almost no link. So you're saying, why should I be good? There is some good news if you're a believer in ESG. It turns out that bad companies face higher costs in terms of funding. Because why? Because stockholders don't buy their shares. It pushes up their cost of equity, pushes down their stock price. Lenders charge them higher interest rates. But in a sense, we almost have to come to a consensus that they're bad companies. The place where ESG has had its biggest success is fossil fuel. Let's face it, nobody wants to be a fossil fuel company anymore. That's why if you look at ExxonMobil or BP, they describe themselves as energy companies and they try very hard to call themselves green energy. Nobody believes it, but you can see why. Because over the last decade, those companies have seen their stock prices drop and their funding costs go up. So if I were giving advice to a company, I would say, look, you're not going to get higher earnings and cash flows by being good, but maybe you will have a lower cost of capital, a lower cost of funding. And it is true that if you are bad, a truly bad company, you're flirting with disaster, because you're walking very close to the line, right? You're always one disaster away. And I gave you the example of Vale facing a $7 billion fine because they walked too close to the line environmentally with the dams they built. And that disaster risk goes up. So if you ask me, what would you tell a company on ESG based on the research right now? I would tell them, don't be bad. But you ask me, should I try to be good? Should I spend money? Well, right now, there is no payoff that I can point to. If you want to be good, accept the fact it will probably cost you money. You'll have nothing to show for it, at least for the moment. So is ESG good for companies? It depends. And in most companies, the answer is, no, neither helps your cash flows, doesn't really help your discount rate either. It might make you feel good. Say, what about investors? Here, the evidence is all over the place. There's some research that suggests that investing in bad companies is better for you as an investor than investing in good companies. Vanguard, for a long time, had a fund, I don't know whether they still have it, called the Vice Fund. You could invest in companies that other people had given up on. So you know how endowments have a list of companies that they don't like to invest in, tobacco companies. So Vice Fund actually goes and invests in all these companies that others don't invest in for a simple reason. If everybody else is dumping the shares, you get at a lower price, you earn higher returns. So there's actually some evidence that you should invest in bad companies. You're saying, I don't want to do that. I'm a good person. I have some good news. There is some other evidence that if you invest in good companies, you will earn higher returns, but almost all of those higher returns come from the G part of ESG. Does anybody know the expansion of each part? E is, of course, environmental, S is social, and G is governance. And it's always struck me that putting G in with the ES never made sense because all of the work on governance has been about shareholder power. And what has ESG done? It's taken G and put it in there and said, look, it works. Why? Because the governance works. In fact, having governance in ESG reminds me of when Germany used to be two countries. East Germany, of course, was part of the behind the Iron Curtain. West Germany was a democracy. You know what the name East Germany gave itself was? Does anybody remember? What did they call themselves? The German Democratic Republic. There was nothing democratic or republic about East Germany, but they called themselves the German Democratic Republic. ESG is the exact opposite. If you buy the base notion of ESG, it's shareholders shouldn't have power. And you've taken governance, which is all about shareholder power, and thrown it in the mix. And it's the only part that delivers positive returns. You're saying, is there no hope for me as an investor to make money on good companies? There is a glimmer of hope. If you get ahead of what the market will view as good or bad 10 years from now, you get ahead of societal changes. And you invest in companies ahead of those societal changes, your returns seem to be pretty good. In fact, there are some activist investors now in the ESG space who actually target what they viewed as bad companies. And after they've taken a large enough stake in those bad companies, they push them to change their ways, be better. And to the extent that they're pushing the company in the direction that the market is going to move, you're ahead of the game. You make returns. Which brings me to the final question of what about society? Because after all, you're saying, who cares about stockholders and investors? If this is good for society, then we should make companies adopt ESG. First, you're on a very dangerous path here because you've essentially asked companies now to be doing things that you and I should be doing as voters in a democracy or as consumers in the society. We want them to bear that mantle. And the problem is, if bad companies are actually more profitable than good companies, over time, we'll actually reward the worst among us by pushing this on the companies that are most receptive to listen to us. I know this is, we don't know how this will play out, but I'll make a prediction. And 10 years from now, you're welcome to email me. Both of us are still alive, assuming, and tell me whether 10 years from now, because ESG is clearly a force out there. Companies all claim to be good. 10 years from now, I want you to look at companies and tell me whether they're better companies than they were in 2020, 2010. Are companies actually going to be doing more good as a result of and I'm not sure they will be. I think what you will hear is companies sounding good. We're already hearing that. There'll be a lot of sounding good, but doing good, no, I'm not sure that this is going, unless there's substance here. We need to bring substance to the ESG debate. Any questions on ESG? Because I've thrown a lot at you. I'm sure you'll go out there and say this, how morally deficient I've been, and kind of, you know what, as long as we push people away who say ESG doesn't work on the basis that this is immoral to even push that view, ESG is not going to work. Now, we need an open discussion of what kinds of companies will benefit from being good, what kinds of companies will be unaffected by being good, and what kinds of companies will actually be hurt by being good, and be open about that reality, because otherwise we're breeding cynicism and essentially a lot of sales pitches that have nothing behind them. Which brings me to my third and final way of dealing with, because right now we're in a bad place, right? Because I threw out maximizing stock price, the utopian. I said, let's try different corporate governance mechanisms, but each of those comes with this consequence of elitist systems. We talked about different objectives, and they all come with consequences. And then we talked about ESG and that stakeholder wealth, and that's not going to help us either. I'm going to go back to my original objective, maximize stock prices. And I'm going to give you my defense of why it can survive and actually be a dynamic, forward-looking system. The best defense I can have for the market-based system is markets have no egos. They correct their mistakes. And every one of the excesses we talked about, managers putting their interests over stockholder interests, taking advantage of lenders, companies lying to markets, and even societal costs, if you let markets play themselves out, and the key is if, each of those comes with a consequence. Let's start with stockholders. Remember I said managers put their interests over stockholders? Now, if you're a stockholder in a company and I put my interests over yours, I'm pissing you off, right? That's a technical term for you, for how you feel financially. I do it again, you're pissed off even more. There's a critical mass to this piss off factor where you finally say, I've had enough. Now, by yourself, there might be nothing you can do, right? You own 1,000 shares. You get pissed off enough, you might just sell the shares. But if you get pissed off enough, then you're receptive. Receptive to whom? To a Carl Icahn, a Bill Ackman who comes in and says, don't trust the managers, they don't care about you. And you're ready because you've seen what managers do to you. I already told you, Carl Icahn is not the deepest thinker on the face of the earth. Or did I tell you that? Maybe I told the valuation class. He isn't. He's not a deep guy. He comes to you and says, you have too much money, give me the money. That's pretty much every Carl Icahn pitch. But you know what his skill is? He targets the right companies. Companies where the piss-off factor has been exceeded, where when he comes and says, don't trust the managers, he said, thank you, God, somebody's listening to us. But the ultimate threat you have is when people get mad, you start to see it show up at stockholder meetings and proposals that come up. I told you the story of Disney and Michael Eisner and how he had this he was an imperial CEO, basically had complete power. The board didn't stop him. And when things were going well, basically people let him do it. But that was 1997, the peak of his power. And the years following, he got increasingly threatened because he did worse things. The stock price went down. And stockholder meetings become restive. People got up and said, why are you doing this? What's the basis for this? But there's the ultimate threat that keeps managers in line. It's a threat of a hostile acquisition. I kind of threw out what a hostile means. You're going to lose your job. Nothing focuses your mind more than the threat of an impending execution. Right? You're a manager, you've been sloppy and lazy, and then you hear this talk of hostile takeover. It's amazing how much more focused you become. So when you think about hostile takeovers, part of you says they're terrible, they ruin firms. In fact, in every Wall Street movie, other than other people's money, when there's a hostile takeover, the bad guy is always the acquirer. The good guys are the people who fight off the acquisition. And people buy into this. There are countries which ban hostile acquisitions. There were states in the US that actually wrote laws specifically banning hostile acquisitions. Now, who are they protecting? In theory, when you ask the people who write these laws, they're protecting good companies from nasty activist investors who might rip the company apart and destroy them. So that you might be protecting some companies that are good companies, but you know the bulk of the companies you protect when you take away the threat of a hostile takeover, it's not well-managed, well-run companies. In fact, if you look at the evidence, the typical target firm in a hostile acquisition is a badly managed, badly run firm. It delivers returns on equity much lower than the sector. It delivers worse stock returns. That is what makes you a target. And if you push managers to a point where they have, stockholders to a point where they have no place to go, you've increased the chance of a hostile acquisition. So I know people don't like activist investors in hostile acquisitions. They're costly, kind of very extreme ways of drawing managers' attention. But you know what? The threat of activist investors and hostile acquisitions is often the only thing that keep managers on the same playbook as you. So we'll stop there, and when we come back, we'll talk about how this is playing out and how boards are changing. We'll finish off corporate governance at the start of the next session. But next session, we're going to get in the meat and potatoes part of corporate finance. We're going to talk about risk-free rates and hurdle rates and and how we think about risk. So I'm actually going to send you a link ahead of that class, because I just put up my post on hurdle rates around the world at the start of 2021. If you get a chance, read the post, because I think it is relevant to what we will be talking about next week. So see you next week. Take care.
Thank you.
Thank you.
Thanks, Professor.